The most asked question is, so if I borrow this leverage from the broker, if the broker borrows me this money, what happens if I lose it during the trade? Do I have to pay it back? Hi guys, that's good. So as I have said on my previous video that I am taking it all the way back. On today's video, I am explaining everything leverage. I have realized that I've been moving a little too fast for most of you guys. So there are things that you do not understand yet and you want to understand. So instead of me answering this one privately, let me just do this thing all the way here, and I'll keep on uploading these nuggets of these videos explaining those little details that you guys are still missing out on. So on today's video, I'm explaining everything leverage. And you know me, I don't like complicating things for no reason. So I'm just gonna try to keep it short and simple. What is a leverage? Leverage is a way for Forex traders to borrow capital to gain larger exposure in the markets. By using leverage with a limited capital, a trader can hold a larger size on charts. This could lead to bigger, massive profits or the dead end of the account, the major blowing of the accounts, as leverages are based on the full value of the position. Let's say you have deposited $1,000 in your account. That is your margin, right? We did explain everything margin in our last video. So you have a margin of $1,000 in your account. That margin of $1,000 in your account, if it is leveraged, it can give you the ability to control a $100,000 position from your account. So that is the all fuss and beauty of using leverage. Leverage amplifies your initial deposits. Leverage amplifies your margin. Leverage amplifies your profits. But leverage blows your account. Why? Because leverage amplifies your losses too. So that's 100,000 leveraged amount, and that's $1,000, which is your margin, will be summed up together in the ratio, and it will make a ratio of 100:1, and that will be called a leverage. Why is leverage expressed in ratios in Forex? The leverage ratio shows how much the trade size is as a result of a margin, which is your initial deposit. For example, the leverage for the trade would be equal to 100:1. That's a ratio. So what does that ratio mean? It simply means for a $1,000 deposit, a trader can trade a position of $100,000 in a participating currency pair. The initial margin required by each broker can vary depending on the size of the trade. If an investor buys a $100,000 worth of GBP USD, they might be required to hold a $1,000 amount as a margin. In other words, the margin required would be 1% of 100,000. As we can see from the table, the lower the margin requirement, the greater the amount of leverage can be used on each trade. However, the broker may require higher margins sometimes due to the currency pair being traded, because brokers usually require different margins for larger trades versus smaller trades. The most asked question is, so if I borrow this leverage from the broker, if the broker borrows me this money, what happens if I lose it during the trade? Do I have to pay it back? And the answer is no. You do not have to pay it back. In a leverage trading, you are required to hold a certain amount of equity in your account to cover possible losses. Or let me just say potential losses. So if the market moves against you and you fall below the required margin, you will face something called a margin call, which we did speak about on our previous video. So I know that you watched that video, so I'm not gonna bore you with the same details again. If you did not see that video, it will be linked on my description box. You can go ahead and check it out. With all these percentages and ratios, what do we consider a good leverage? Is leverage a good thing to do? If yes, which one should we select? Which one is the good leverage? In my opinion, a low leverage is a good leverage. Actually, we use leverage. Even if you don't know this, you are using leverage. Everyone who's trading, whether you are in a demo or live account, trust me, in most cases, you are already using leverage and you just don't know. But yes, leverage is good to use, but low leverage. Because low leverage can enable you to minimize risk while making reasonable profits. So low leverage is the best way to learn, to grow, to find yourself in the Forex markets, because you are not losing too much. Yeah, you are not winning too much either, but it's fine. You are growing. When you are winning too much, you can maximize your leverage if you want to. But as a beginner and also as an intermediate, low leverage is the best way to go, because you really make reasonable profits, but still not risking too much. So in my opinion, low leverage is the best. Next question is, can I trade Forex without using leverage? And the answer is yes, you can definitely trade Forex without using leverage. But this will mean you will only earn profits based on the actual movement on the currency pair or index or whatever that you are trading. While with leverage, you can amplify your profits with just a borrowed funds, which you don't actually have to even pay back. So you can use that as an advantage for you, but don't be greedy with it. Use it smart. Next frequently asked question is leverage and lot size the same? And the answer is no. Leverage and lot size are two different things. They sound similar because if I increase my lot size, I make more profits, right? And if I increase my leverage, I make my profits, right? But it sounds similar, but it's definitely not the same. As I have said, leverage is simply a borrowed funds from your broker to amplify your profits. And a lot is a unit measuring your transaction amount. So it's definitely not the same. Thank you so much for your continuous support. I hope I answered most, if not all, of your questions. Please go ahead and make sure that you are subscribed and your bell notification is turned on. May the peace of God rule in your heart. I'll see you on the next video.